Hello everyone. This is part two of my video series looking at Secure Trust Bank. We'll be going through the vehicle finance section today, having gone through the a bit of a company overview, bit of an executive summary, investment piece, history, and then a deep dive into the retail finance segment last episode. So yeah, let's move on this time to have a look at the vehicle finance. So yeah, just a quick note before I do. This is now entering into the bit that the section that you'd have to that's behind the paywall effectively. So um, anybody who wanted to go and have a look at this would have to pay to see it. So yeah, we're going behind the veil here, but um, yeah, we'll get onto that stuff later. But anyway, yeah, so start with a quick overview. So STB entered the vehicle finance market in 2008 under the Moneyway brand, providing hire purchase loans to near-prime customers for used car purchases. At the time, near-prime was seen as an attractive niche, being lower risk than subprime, but generally avoided by the larger banks, especially in the aftermath of the financial crisis. I'll stress at this point that all its lending is focused on used rather than new cars, principally because new used cars depreciate more slowly and thus provide greater security to the lender in the case of default. In 2018, a transformation program was initiated to expand into the prime and stock funding markets, with the latter involving lending to car dealers to fund purchases of used car stock at auction and through part exchanges. The stock funding business was launched in 2019 under a newly created V12 vehicle finance brand, followed in 2021 by the launch of hire purchase and personal contract purchase (PCP) products under the new brand. In 2021, the near-prime used car finance market was estimated to be worth £1.3 billion, while the used car prime hire purchase and PCP markets were estimated to be worth 7.7 billion and 9.4 billion, respectively. Therefore, the move into prime lending has expanded STB's addressable market from 1.3 billion to 18.4 billion pounds in 2021. In 2023, this total addressable market has grown further to 22.1 billion pounds, largely due to inflation and a shift in demand from new to used cars, with all the supply constraints, etc., through the pandemic that impacted the sale of new cars. Another aspect of the transformation program has been the digitization of the customer journey, achieved by integrating the V12 retail finance technologies into the vehicle finance business. This process remains underway and should lead to significant cost efficiencies when complete. I think they're anticipating completing that by the end of this year. Let's walk through each of the products in a little more detail. So first we have a look at the near prime hire purchase. As mentioned above, this is offered under the Moneyway brand, which has built a good reputation with customers, supported by a 4.8 out of 5-star rating from 5,973 reviews on Trustpilot and 4.7 out of 5-star rating from 4,613 reviews on FIFO. Finance conditions. The loans are offered with a term of 24 to 60 months, with a maximum car value of £20,000. Age of vehicle must be less than 10 years at the start of the agreement and less than 15 years at the end. And there's a maximum mileage of 100,000 miles. It includes petrol, diesel, hybrid, and plug-in hybrid vehicles up to and including 5 litres. For those unfamiliar with hire purchase, the customer pays off the full value of the vehicle plus interest over the course of the loan agreement. So it's important. It's the reason the other category, the personal contract purchase, they don't pay off the remaining. They just kind of effectively leasing the vehicle, and there's a balance left at the end which they can optionally pay off or they can use as long as the car has retained that value, return the car and get a new one or whatever at that point. And they don't want to do that for the near prime because that's effectively giving the consumer more credit there. Because there's a instead of them having to pay off the entire value, you've always got that little outstanding debt or substantial outstanding debt at the end, which is the sort of remaining value of the car, which is so that's why they would only want to offer that on the customers with a higher credit rating. So now we move on to prime hire purchase. So this is one of the products offered under the V12, the new V12 vehicle finance brand. So we don't have much in the way of reviews to look at yet, but the use of the V12, the use of V12 in the name is likely to generate some positive connotations for consumers familiar with the retail finance offering. Since the prime segment of the market is associated with lower default risks than near prime, the interest rates offered to customers are lower and the loan conditions looser. Finance conditions. Loans are offered with terms from 24 to 60 months. The maximum car value is £55,000 and a minimum of £3,000. So this compares to 20,000 for the near prime. So they're prepared to offer a lot more. The age of the vehicle must be less than 10 years at the start of the agreement and less than 15 years at the end. And the maximum mileage is 125,000 miles compared to 100,000 for the near prime. And the same conditions around vehicles, supported vehicles. So petrol, diesel, hybrid, and plug-in hybrid vehicles up to and including 5 litres. In 2021, its year of launch, new prime hire purchase lending was £14.6 million, growing to £83.4 million in 2022. I don't have a separate figure for 2023, but the combined new prime lending, so hire purchase and personal contract purchase, was £114.8 million across the two categories. So now we move on to the prime personal contract purchase. So this is the newest V12 vehicle finance product rolled out at the end of 2021. PCP can be an attractive option for customers as the monthly payments are lower than HP and over a similar term. This is because they don't repay the full value of the vehicle, instead paying an amount approximately equivalent to the expected depreciation over the loan term. The residual value of the vehicle at the end of the finance agreement is referred to as the guaranteed future value, or GFV, and is dependent on annual mileage remaining within agreed limits and the condition of the vehicle being in line with that expected from normal wear and tear. At the end of the loan agreement, the customer has the option to buy the vehicle for the guaranteed future value, part exchange it if the value exceeds the GFV, and they want to use the difference as a deposit towards another car, or they can return it to V12 vehicle finance. In the case of a return, additional charges may be applied if the mileage exceeds the agreed limits or the car was in worse condition than expected. So loans for the PCP, prime PCP, are offered with terms from 24 to 48 months, maximum car value of 55,000, a minimum of 3,000. It's the same as a high purchase there, but a shorter, a narrower band of loan terms, 24 to 48 versus 24 to 60. for the hire purchase. And the age of the vehicle must be less than 5 years at the start of the agreement and less than 9 years at the end. So yeah, much more critical about the age of the vehicle because they wanted to be able to sell it, or they wanted to still hold its value. And I guess it's harder to depreciate the value of a vehicle once it gets past a certain age. And with the hire purchase, the V12 vehicle finance is not doesn't have that liability of the vehicle needing to be able to sell it at the end, hanging over it because the person would have paid off the whole value. So the maximum mileage of 108,000 miles at the start of the agreement and 120,000 at the end. So a little different there as well. And another difference with PCP is because you're kind of leasing it, you have annual mileage limits, and which should affect the monthly payment. And in this case, the limits are between 6,000 and 30,000 miles. And all the same vehicle categories apply. In 2022, new prime PCP lending was £10.6 million, and as mentioned above, it contributed to a combined new prime lending total of £114.8 million in 2023. Right, so now we move on to the final category, which is stock funding. V12 Vehicle Finance has integrated its stock funding product into the platforms of a wide range of auction partners, including, in some cases, working with them to develop a bespoke mobile app. Partners include Aston Barclay, City Auction Group, Shoreham Vehicle Auctions, Central Car Auctions, Wilson's Auctions, the Fleet Auction Group, Eastbourne Car Auctions, and CD Auction Group. Dealers are offered 100% of the hammer price of purchased vehicles, plus auction, refurbishment, and delivery fees. And in many cases, the process of buying on finance is as simple as a single button tap on an app. Having already entered your details and applied for the finance beforehand, of course. So the finance conditions are as follows. The loans are offered with terms up to 120 days, a maximum of 50,000 for prime and 65,000 for franchise dealers on a single vehicle. Franchise being, in this case, someone that owns multiple dealerships. Vehicles aged up to 15 years old and a maximum mileage of 150,000 miles. And they cover a bit of a wider range of vehicles. So they cover petrol, diesel, EV, and hybrid cars. So electric, there was only hybrids covered on a personal finance level. But they also cover EVs for commercial customers, and also light commercial vehicles up to 3.6 tons. In 2021, the stock funding contributed £65.4 million to new business lending, though the short loan durations mean the average lending balance will have been significantly less. A better metric provided in the 2023 annual report is the number of active dealers, 250 in 2023, up from 193 in 2022, with credit lines totaling £51.5 million. And in 2022, it was £37 million. These credit lines will not be fully drawn all the time, however. So now we'll move on to talk a little bit about commission. So it is standard practice for lenders to pay a commission to dealers and brokers when they sell finance. There is, however, some controversy around the use of certain discretionary commission arrangements where the commission varies with the interest rate applied to the loan, and the dealer/broker is able to exercise some discretion over the said interest rate. This creates a misalignment between the interests of dealers/brokers and customers, and that can result in the customer being unknowingly overcharged relative to their risk profile. So it's saying here that if they're incentivized if the dealers or brokers are incentivized to issue a higher interest rate to the customers, because they're incentivized because they get a higher commission. So the commission increases with the interest rate that they're able to apply. So that means that they're potentially not going to give the customers the best deal because they want to get the highest commission. Such arrangements were banned by the FCA in January 2021, and it announced in January 2024 that it would be conducting a review into their historical use. STB operated some such arrangements from 2009 until June 2017, so is potentially exposed to any charges resulting from the FCA review. The company has accordingly recognized a contingent liability, but not yet made any provisions on account of the current uncertainty regarding the implications for the industry. The current expectation from management is that the final financial impact will be relatively low, as the amount of finance sold under discretionary commission arrangements during the aforementioned period is small. Another announcement from the FCA is expected in Q3 2024, which will hopefully provide greater clarity on the matter. And I think they've basically said they're going to push it back till next year. The FCA have. So yeah, we haven't had any progress on this really, other than a number of other banks have recognized provisions, banks that were doing much larger volumes. So Close Brothers, which is, I think, one of the example companies, we're looking at the competitor analysis, and Lloyd's, I think, as well. Yeah, a few others have actually recognized quite substantial provisions in the hundreds of millions against this. But yeah, I think STB has had relatively minimal exposure, but there could still be some impact. To keep in mind. So now we'll go on to have a look at the loan book growth like we did for the retail finance segment. So STB's vehicle finance net loan book has grown from 274.6 million pounds in 2017 to 467.2 million pounds in 2023. This equates to a compound annual growth rate, or CAGR, of 9.26%. Though, as you can see, the path was far from smooth, with a sharp drop in 2020 due to the pandemic lockdowns. Growth in new business volumes has been significantly faster, 22.01%, to the point where new business volumes actually exceeded the value of the net loan book in 2022 and 2023. The reason for this lies in the formation and growth of the stock lending business, where loan terms are much shorter and consequently increase loan book turnover. Net interest income and risk-adjusted income. Unlike the loan book and new business volumes, net interest income was pretty much the same in 2023 as 2017, with the values of 44.1 and 41.8 million pounds respectively. The former value being the 2023. 2017 is an estimate due to the interest expense not being disclosed. The reason for this is twofold: the introduction of lower risk prime lending, which has a lower rate of interest than near prime, and rapidly rising base rates that have squeezed net interest margins due to a lag and limit to passing them on to customers, much as we saw with retail finance. It's harder to draw conclusions for risk-adjusted income due to large swings in impairment charges impacting the values from 2020 through 2022. That said, we should expect the gap between net interest and risk-adjusted margins to narrow going forwards as prime lending grows as a proportion of the overall vehicle finance loan book. So you can see some really big swings in 2021. That was, I think, actually went the risk the cost of risk actually went negative, and so the risk adjusted margin exceeded the net interest margin, and then it had in 2020 with the outset of the pandemic, though it went the other way. It was a big swing downwards. So it's fluctuated quite wildly, and this is probably the worst segment for impairments. It can swing quite wildly, but you notice still that they still made a risk adjusted income in every year, which even though they had these big swings in certain years had higher losses than others, loan impairments so on than others. But yeah, you're not really seeing the growth in lending being passed through at this point because there's been a shift in the lending type to sort of less profitable, but hopefully more stable and less likely to lower risk lending. Let's have a quick look at market share. So in the consumer point of sale market for used vehicles, STB has grown its share of new business volumes from 0.7% in 2021 to 1.2% in 2023. If we look only at the near prime segment, I'd estimate the company's market share to be more like 10% because it's obviously a much smaller overall market, and that's still where the majority of STB's loan book resides. Similarly, while I don't have a market share figure for the stock funding business, it seems plausible that it'd also be larger than 1.2%. Given the progress the company's made in building up partnerships with auction houses. So, yeah, don't know exactly on this. There are quite a few other businesses to offer stock funding, but it's still more niche than the prime lending market for new and used vehicles. In any case, there's certainly plenty of room for growth, particularly within the larger prime segment where STB is a relatively new entrant. Competition. There are many players in the motor finance space, but they can be broadly divided into three groups: large banks, vehicle manufacturers, and specialist lenders. I'll endeavor in the following sections to give you an outline of one company from each group. So we start with Black Horse Limited. Black Horse Limited is a subsidiary of Lloyds Banking Group, therefore falling squarely into the large bank category. It offers a wide range of products, including wholesale stock funding, hire purchase and personal contract purchase on new and used cars, motorcycles, and caravans, and lease purchase on light commercial vehicles. With the wholesale funding, they offer two product options: unit inventory finance and traditional funding, aka revolving credit facility. The former aligns pretty closely to STB's stock funding business, with the funding being provided against individual vehicles. There are, however, some notable differences, including the fact that they only lend a maximum of 80% of the vehicle's value for used vehicles, unlike STB's offer of 100% plus auction, refurbishment, and delivery fees. The traditional funding option is much closer to a revolving credit facility, where funding is provided against a percentage of the total dealer stock value rather than any vehicle value. The consumer-focused finance options are broadly comparable to STBs, though they do offer finance on a wider range of vehicles. I'd also expect Black Horse to be squarely focused on the prime segment of the market. At 31st of December 2022, the company had a net loan book of £12,274,000,000 after subtracting impairment provisions of £221 million. These loans and advances were funded predominantly by borrowings from Lloyds Bank plc, the parent, which in turn will likely have come from customer deposits. Interest income for the year came to £553 million, while interest expense was £202 million, giving a net interest income of £351 million. This interest expense is, of course, set by the parent company, but you would expect it to reflect Lloyd's own cost of funding, as evidenced by an increase in interest expense from £123 million in 2021. At the same time, interest income decreased from £576 million. In February 2024, Lloyds Banking Group set aside provisions of £450 million to cover potential compensation claims relating to the aforementioned FCA investigation into variable commission arrangements. It was the first company to do so and indicates that Lloyd's management sees a real possibility of a compensation being paid. So next we'll have a look at Volvo Car Financial Services UK Limited, or VCFS UK. VCFS UK is a joint venture between Volvo Car Corporation and Santander UK plc, with the former holding 49.99% of the share capital and the latter holding 50.01% through its subsidiary Santander Consumer UK plc. The company began trading in 2021 and offers finance products to customers of Volvo, Polestar, and LEVC. These include variants of hire purchase and personal contract purchase, in addition to subscription and lease options where the customer never owns the car. As you'd expect, the focus is on facilitating the sale of new cars from the three vehicle manufacturers. In the year ending 31st of December 2022, BCFS UK provided finance for 85.2% of Volvo's retail car sales, equating to 11,540 out of 13,540 vehicles. The total amount advanced to customers was £792 million. At 31st of December 2022, the company had net finance lease receivables of £819 million, net loans and advances of £443 million, and net operating lease assets of £244 million. From these assets, it generated £43.3 million of interest income and £35.5 million of operating lease and other income, set against £19.7 million of interest expense, £38.4 million of administrative expenses, £3.7 million of impairment charges, and £3 million of tax, to give a net profit of £14 million. The business is financed primarily through borrowings from Santander, which will in turn raise funding from its depositors. As VCFS UK started trading after discretionary commission arrangements were banned by the FCA, it is not at all liable for any compensation claims. So finally, we'll have a look at Close Brothers Group plc. The Close Brothers Group plc is a merchant bank and FTSE 250 constituent, around 6 times larger than STB on a shareholder equity basis. It offers vehicle finance through the Close Brothers Motor Finance brand with a comparable set of products: hire purchase, personal contract purchase, and stock funding on predominantly used vehicles. The stock funding product is more restrictive than STB, with funding only covering 80% of the vehicle value, but it does also provide more traditional finance to dealers, much like Black Horse. The net motor finance loan book at 31st of July 2023 was £1,948 million, of which the majority was attributable to hire purchase and circa 9% to personal contract purchase. At an operating level, the company groups the income and expenses of its motor and premium finance total net loan book £1,053,000,000 together into one retail segment. Operating income for the segment came to £248.1 million, comprising net interest income of £218.4 million and non-interest income of £29.7 million, so commissions, etc., which was offset by operating expenses of £164.4 million and impairment charges of £49 million to give an operating profit of £34.7 million. Close Brothers has also recognised a contingent liability in relation to the FCA investigation into discretionary commission arrangements, but as yet hasn't made a provision for potential compensation claims. I think they now have. I have to have a look into that, but I think I saw that they've now made actual. I think they might have raised some. I think they sold off a part of the business, something like that, before. I think it might have been, just from memory, something like £300 million, which was a large part was to cover this potential liability. So yeah, it's going to be a considerable hit to them as well, having done a lot more of it and continued it until much more recently. So that sums up that completes the coverage, this section on the vehicle finance segment. Next time I'll take you through the real estate finance. I might bundle the real estate finance and commercial finance. Might do them as two separate episodes, might do them together. They look like the second one is pretty short. So yeah, that would be a grouping of sort of the business finance segment. So yeah, we'll have a look at that next time. And then there'll be, after that, can go through the rest of the report, which is looking at the overall group financials and their progress over the years, and breaking down, analyzing those, and then looking at sort of the investment outlook and so on. So again, if you're interested to give this a read, you can get the whole initial section up to the end of the retail finance segment for free. Just go and have a look over at firmreturns.com. And there's also a link in the description for this video. And if you're listening on a podcast form, in the description there as well. And yeah, if you're interested to read more, I send out updates. So we've had a subsequent to writing this report, I've also put out a company update on STB. So yeah, this was put out on 22nd of September, so just over a month ago at the time of recording this. Yeah, and there'll be future updates on this and all the other companies in my portfolio that I've covered. On a basis, these are all entirely free. If you want to get them, you just need to sign up to the newsletter. They get straight into your inbox. And then, yeah, the research reports, like this one we've been going through on Secure Bank, go on a less frequent cadence because they are much longer. I'm doing some research now into an airline called Jet2, which is likely, I'm reading through some of the most recent annual reports, but it's looking like it's most likely going to be my next report. So that will be come out. It takes quite a while to write these. The Secure Bank one took for 5 or 6 months. So it was ends up being about 16,000 words in total. But And I expect it'll be fairly similar for Jet2 if I do it, because I want to do a decent amount of coverage of competitors in the space, other airlines and so on. So yeah, there'll be quite a lot that I want to do there with that one. And it's been around for a good amount of time, so there's plenty of historical data to look back over and analyze. But anyway, yeah, if you're interested to get these you'll get the cut down version. It might just be for the next one. It might just be the executive summary. I was a bit more generous. I gave the initial retail finance segment with this one as well, Secure Trust Bank. But it might just be executive summary and so on in the future. So if you're just wanting a investment pitch or whatever, then that's going to be suitably covered for free. So you just sign up to the free newsletter. That's absolutely fine. If you're interested to dig more into the details, look at the analysis I've done and so on, then yeah, have a look at the paid subscription options. It's the best option really is to pay £30 for the full year, which equates to £2.50 a month. If you don't, then it's £15 a month. The idea being, if you just wanted to read one report, £15. And because I do roughly about 2 reports a year, £30 for those two full reports in your annual subscription. So yeah, so please give that a consideration if you're like get value from the research I'm putting out. It takes a long time to write. But yeah, largely it's due diligence. I'm doing it as due diligence for the companies because most of these ones I'm writing up, I actually own. I don't own DSW Capital after writing that, but most of the other companies I've written up, I have owned uh, either during the write up for some of them or after completing it for others. But anyway, yeah, thanks. Thanks for giving this video a look or a podcast a listen. And I'll see you in the next one for the part 3, which again, I'll be covering the business finance segment.